Top-down and bottom-up approach. Analysis of financial statement by Manish Nikam, roll number MB21093. Top-down versus bottom-up, an overview. Top-down and bottom-up approaches are methods used to analyze and choose securities. However, the terms also appear in many other areas of business finance, investing, and economics. While the two skills are common terms, many investors get them confused or don't fully understand the difference between the approaches. Each approach can be quite simple. The top-down approach goes for the general to the specific. The bottom-up approach begins at the specific and moves to general. These methods are possible approaches for a wide range of endeavors, such as goal setting, budgeting, and forecasting. In the financial world, analysts or whole companies may be tasked with focusing on one over the other, so understanding the nuance of both is important. Key takeaways. Top down usually emphasizes a vast universe of macro variables, while bottom up is more narrowly focused. Top down investing strategies typically focuses on exploiting opportunities that follow market cycles. Bottom up approaches start with local or company specific variables and then expand outwards. Fundamental analysis is an example of a bottom up investment approach. While top down and bottom up are distinctly different, they are often used in conjunction with one another. Understanding top down and bottom up approach. In a top down approach, you essentially adopt an EIC approach to investing. E refers to economy, and you first take a call on whether the domestic and global economic scenario is conducive for investment. Once the economy condition is satisfied, then you assess the I, which represent the industry in which the company operates. You look at factors like how the industry is growing, what are the input costs, what are the output prices trends, entry barriers in the industry, etc. Once the investor is convinced that the strengths and opportunities outweigh the strength and weakness of the industry, they then you move to the last step. C refers to the specific company where you propose to invest and that what has passed the economy and industry test. Then you drill down to financials like profitability, solvency, liquidity, efficiency, valuation, etc. It is based on this EIC approach that the top-down approach is implemented. Bottom-up approach. Here the investors first analyzes the company, followed by the industry analysis, and final the economic analysis. Here the investors believe that if the company has good fundamentals, then the relevance of the industry and economy is secondary. The they identify an undervalued company and make investment accordingly. When can top-down approach work well for investors? The top-down approach works very well in case the market is being largely driven by macro factors. Let us take some practical example. Back in 2008, at the peak of the Lehman crisis, all asset classes across the board and crosses and across the world were crashing. Similarly, in December 2015, when the US Fed hiked Fed rates for the first time, equities across the world lost nearly $13 trillion in terms of market capitalization. In such circumstances, top-down approach can work well. Another case is where when the markets are quoting or salvating valuation. Take the case of mid 2000 and March 2000 when the Nifty was quoting around 11 PE. In such circumstances, a top-down valuation augmented is good enough to buy stocks. Top-down can work well here. Another case is where the key trigger for marketing in a global event. It could be Greek crisis, the oil prices crisis, or even bet on Eurozone. All these are macro stories where the top-down approach can work pretty well. Instead of focusing on top-down versus bottom-up investing, it is more important to understand which method works better in what circumstances. Understanding top-down investing strategy. As the name suggests, the top-down investing strategy starts from the top. Yet the investors start analyzing from the top level or a macro level. The investors will start analyzing the economy, followed up followed by the industry and later the company. At each level, elimination will take place according to the goals and risk appetite of the investor. In simple words, the focusing of this strategy in macroeconomic. These investors identify attractive economies and later attractive industries within. Later from the respective industries, the best available company is selected. Here, investors give due weightage to the economy and the industry segment decide focusing on the best performing companies in the segment or the sector. When does bottom-up approach work well for investors? The basic difference between top-down and bottom-up approach is that latter is more stock-specific. The argument that stocks can be economy agnostic and sector agnostic is true most of the time, if not all time. There are some basic rules that one needs to follow. In time of high volatility, say VX about 25, your bottom-up approach may not really work as the focus shift toward the predominant macro risk. On the other hand, mid-cap stocks are more amenable to the bottom-up approach than to a top-down approach. This is because most mid-caps operates on a unique set of economic drivers, which are not exactly connected to the broad macroeconomy. We have been we have seen stocks like Britannia and Lupin give phenomenal multi-bagger returns between 2010 and 13, despite the market being tepid overall. Understanding bottom-up investing strategy. As the name suggests, the bottom-up investing strategy starts from the bottom. Yet the investor starts the analysis from the bottom level or from the micro level. The investors conduct analysis at the company level, followed by the industry at the end and at the end economy. This strategy focuses on the micro level element. The investors will analyze many companies on the basis of fundamental and will select the best suitable company. The investment vehicle goals should match with the investor goals. Top down approach analysis of the economy and the market, analysis of the economy, section industries, analysis of the company. Bottom up approach economic indicators, stage of the business cycle, market, industry structure, competitive advantages, economic goals, economic modes, financial position, profitability, cash flow. Thank you.